Hello, friends. Today, we will not just talk about a success story. We will take a deep 10-minute journey into the mind of Paul Tudor Jones, one of the sharpest intellects in financial history, a man who feels the market as if it were a living organism. If you are ready, let's go back to that misty and tense October of 1987. The darkest day in Wall Street history is approaching. No one realizes it yet, but Black Monday is at the door. The Dow Jones Index will drop 22.6% in a single day, meaning the world financial system will shake like a house of cards in one afternoon. While people were losing their fortunes and experienced traders were frozen in front of their screens, one man saw that day coming weeks in advance. Paul Tudor Jones did not just survive that great disaster, he doubled his fortune that day. This was not a victory of luck, but of months of preparation and ironclad discipline. Paul Tudor Jones was born in 1954 in Memphis, Tennessee. In his youth, he was involved in boxing. He would carry that aggressive but cool-headed stance he gained in the ring to the stock market floors years later. Actually, his path was already drawn. He could have been a brilliant MBA student at Harvard. However, instead of getting lost among theoretical books, he chose the wild and noisy rhythm of real life. He dropped out and entered the famous cotton market of New Orleans. That was his true university. In New Orleans, amidst the humid air and shouting sellers, he met his mentor, Eli Tullis. Tullis was an old-school, very tough man. The most famous lesson he gave Jones was this: losers average losers. This sentence is the deadly line between a professional trader and an amateur investor. In other words, if your position is losing money, adding more money there by saying the price will return anyway is actually just accelerating your own end. Jones learned this lesson with such blood and sweat that he made it a way of life to start every morning in the market with this mantra: I start the day assuming every position I have is wrong. Imagine starting work every morning by accepting that you might be wrong, not that you are right. This is the bowing of the ego before the market. By 1987, Jones's fund, Tudor Investment Corporation, was still very young, but he and his partner, Peter Borish, had a plan. Borish had taken old Dow data and overlaid the chart of the 1980s with the chart from before the 1929 Great Depression. The result was chilling. The two charts were moving almost like twins. When Jones saw this, he remembered Mark Twain's famous quote, "History doesn't repeat itself, but it often rhymes." There was incredible euphoria in the market. Everyone was getting rich. However, Jones followed that fractal and opened massive short positions in October. While those around him thought he had gone mad, Jones did not panic when the market tumbled off a cliff on the morning of October 19th, because he had already lived that moment in his mind months before. He closed the day with a 62% profit. The money he earned in 1 month was an amount most hedge funds could not even dream of in 10 years. But what made him a legend was not the money, but the courage to read that data and the preparation. Jones was always known as an aggressive trader, but this was not a chaotic aggressiveness. In his philosophy, aggressiveness is actually a defense strategy. Wait for the big opportunity, hit with all your strength when you see it, and then withdraw quickly. In his own words, my job is to find the best risk every day, but to be able to close that risk very quickly. This discipline formed his psychological superiority. Instead of suppressing fear, he used it as a signal. According to him, if read correctly, fear is the clearest compass showing the balance of the market. Jones uses the 5-to-1 rule in risk management. That is, in a trade where he risks losing $1, he aims to earn at least $5. This way, even if he is wrong in 4 out of 5 trades, he wipes out all his losses and turns a profit with a single right trade. In 1988, this time he set his sights on Japan. As the Nikkei index raced toward 40,000, everyone was saying, "This time is different. Japan will buy the world." Jones's answer was clear. This is just the Japanese version of 1929. According to him, every bubble goes through the same 3 phases. First, euphoria, where everyone thinks they are a genius. Then, indifference, where no one believes even as prices fall. And finally, panic, where liquidity suddenly vanishes. Jones's success was not in predicting bubbles, but in reading the human psychology within that bubble. Because he saw the market not as an economic system, but as human behavior. Behind Jones's intuitive style, there is actually a very solid and systematic core. He did not like complex algorithms. The 10-month moving average rule, which many professionals still use today, is identified with him. The rule is simple: if the price is above the 10-month average, stay in the game. If it is below, no matter how much you are in love with that asset, sell it and move to cash. Tests conducted from 1900 to the present day have proven that this simple rule protected against all massive crashes, from the dot-com bubble to the 2008 crisis. As Jones said, simplicity is more valuable than complexity, because simplicity is what is applicable. Years later, Jones would say, "You can't control the markets, you can barely control yourself. But if you control yourself, the markets cannot resist you." He believed that investors lose not because of technical ignorance, but because of emotional blindness. That's why he added meditation, deep silence, and constant self-reflection to his daily routine. For a trader, the biggest enemy is not rival funds, but the noise within oneself. Success is not a result of a trade, but a state of mind. Paul Tudor Jones did not just remain a trader. The fund structure he established in the late 1980s has become the standard of the modern hedge fund world today. He was a pioneer of the 2 and 20 model, 2% management fee, 20% performance fee. He was one of the first names to separate the concepts of alpha and beta. In other words, he would not settle for the general return of the market. He would always chase that insight that makes a difference. Additionally, with the Robinhood Foundation, which he founded, he established a massive philanthropic network fighting poverty in New York. Some saw him as a modern Robin Hood, while others criticized him for his luxurious lifestyle. But he was clear. Money itself is neutral. How you use it defines you. Today, in the complex and AI-filled world of 2025, Jones is still an active observer. When he appears on CNBC, he compares today's excitement to the tech bubble of 1999. Artificial intelligence, risk appetite, and excesses. According to him, the same human psychology is at play in every cycle: hope, greed, and denial. In recent years, he has also drawn attention with his interest in Bitcoin and gold. He became one of the earliest macro traders to believe in the concept of digital gold in a world where paper money loses value. And he still warns with the same sentence: if you want to jump onto the last car of a train, you must first know the drop-off point. In closing, we can reduce Jones's 40-year legacy to 5 basic principles. Risk comes before everything else. Learn to protect what you have before making money. History is a rhythmic teacher. If you can hear the rhyme of the past, you can sense the future. Simple systems are stronger than complex ones. A complex model that you cannot implement will only leave you stranded. The ego, not the market, is your enemy. You lose the moment the desire to be right gets ahead of your desire to make money. Wealth requires wisdom. Money is only a tool. If you don't have a philosophy to manage it, it is just a burden. Remember, friends, the market is never wrong, but opinions often are. True mastery lies not in predicting the market, but in knowing oneself and acting in harmony with those massive waves, because those who know the rhythm of the market are those who can sense the future. Thank you for listening.